Hey there, everyone. Welcome to Broadband Deployment News. Starry Internet has announced that they are seeking a buyer or potential merger to address some cash flow issues. Be right back. Thanks for joining me. Rick Uzzi here with Broadband Deployment News. So I reported about Starry having some issues. They've been in the news a lot lately. So they announced some layoffs just a couple of weeks ago. And then just a week or two before that, they announced that they were not going to be participating in the RDOF awards that they had won in the bid. So this is just kind of a continuation of what's been going on. So just wanted to kind of walk through this article here just to see how things are going for them. So you can see here, Starry seeks buyer as cash runs low. Fixed wireless service provider Starry told investors it's hired an investment bank, PJT Partners, to advise the firm on a merger, sale, or other balance sheet solution. Co-founder and CEO Chet Kanogia said Starry had $29.4 million cash at the end of September, down from $99.7 million at the end of the second quarter. Kanogia said potential buyers, investors have already expressed interest in Starry. He said some of the parties are financial players and others are strategic investors, meaning companies running businesses that could be synergistic with Starry's. Starry offers fixed wireless access service using millimeter wave spectrum, which can transmit large amounts of data for relatively short distances. Multi-tenant apartment buildings in urban areas are Starry's sweet spot, and Kanogia said demand is strong. So they picked up on the millimeter wireless spectrum. So when we first started hearing about 5G, there was a lot of, I guess I'd call it hype on 5G. It was considered it was going to be like a broadband killer. And it actually is. Actually, these days, it is making quite an impact. But back then, everybody was talking about millimeter wave because millimeter wave is very, very fast. So you can do, for example, gigabit internet with millimeter wave, but as it mentions here, relatively short distances. So the issues with millimeter wave is you need lots of small cells, so it works on a small cell technology. That's where you see cells on buildings and light poles, and they have to be fairly close to each other, and they have to have line of sight. So it works best maybe in an urban area where there's lots of people living together, where you've got a building, for example, that you've got line of sight to another cell, and therefore you can get internet, broadband internet through millimeter wireless to that building. But the millimeter wave is very prone to attenuation. So any kind of, it can't go through walls, doesn't deal well with trees or leaves, or even humidity in the air can kind of mess up the signal. So that's why millimeter wave, even though, again, there was a lot of hype about 5G and how it was going to be providing gigabit internet all over the place, it was really where it was going to be successful was in urban markets. Now, 5G on the mid-band spectrum has had quite an impact on other broadband providers, like some of the larger cable operators, as players like T-Mobile and Verizon and AT&T have got mid-band spectrum, especially T-Mobile has been out really pushing that and kind of the nationwide 5G. They've got a lot of mid-band spectrum. So while they can't offer gigabit internet, they can offer speeds that are well over 100 megabits per second that would reach that would exceed what we're trying to do as far as a lot of the broadband dollars that are coming out now, the 100 by 20 kind of minimum. So they can do that with the mid-band spectrum. So that's really had more of an impact than this millimeter wave. But millimeter wave does play pretty well in these urban markets. And what Starry's been focusing on are these are apartment buildings. And a lot of these buildings are in low income or even really government-assisted kinds of buildings. So they actually have plans for buildings that are, where all of the tenants there would qualify for government assistance, and they provide discounts on those. So that's kind of how they've been moving in their marketing. So, as they say, that's their sweet spot, and they say the demand is strong there. With more than 10,000 net new ads during Q3, Starry grew its customer base to 91,297, up 66% from Q3 2021. About 20% of the apartment units that could get Starry service are signed up, Kanogia said. Starry activated about 50,000 new apartment units this quarter for a total of roughly 450,000 activated units. So those are activated units, but as you can see, that's not equivalent to their customer base. So just because a unit has access to it doesn't mean that they're going to take it. But ARPU is not growing as fast as the customer base, Kanogia said. He attributed this to our liberal use of a 4 to 6 week promotional period and added, there's been no change in rack rate pricing and demand for the service is strong. Q3 revenue was $8 million, up 36% from a year ago. the year ago quarter, but the cost of revenue grew 43% year on year, and expenses ballooned by 120%, and R&D costs rose 35%, leaving Starry with a net loss of $60.3 million for the quarter. So that's where their issue is. And the company went public back in late March, so they got a lot of cash through that, but they burned through that cash very quickly. It mentions here the workforce reductions, change of focus. So last month, Starry implemented severe cost-cutting measures to try to cut its losses. Despite our continued performance, the macro environment has presented challenges to our financing and pushed out the timeline, forcing us to take immediate steps to rein in cash burn through the cost-cutting measures announced in October. I said Starry has eliminated, and this was in their company's Q3 call, so this was back just a few weeks ago. He said Starry has eliminated 50% of its workforce, so I think it was about 500 people that they had to lay off, and has paused plans for an expansion into Las Vegas. In addition, he said the company made the difficult decision to withdraw from the FCC's Rural Digital Opportunity Fund, or RDOF. So Starry was one of the top bidders and winners in RDOF. They were like number 9 out of the top 10, $268 million that they won through RDOF. And they made the decision to default on all of those. They had been announced that they were ready to authorize by the FCC. And then several weeks later, they announced, no, we're not going to do it. And I think, obviously, because of these cash problems with RDOF, they'd have to have a lot of cash to be able to meet the commitments that they have. And as I mentioned last time, with RDOF, you don't get all of that money all at once. That's basically spread out over 10 years. So they'd have to be doing these builds over 10 years, but also the money that they get is 1/10 of that every year. So they made the decision that it would not make sense for them to go through with RDOF. And unfortunately, because of them, there's going to be some pretty substantial losses as far as fines that they have to pay on these areas that they did bid, which is like $3,000 per census block where they had been awarded money. And then I think there's a cap of, I remember, 15% of a cap on that. So it's still a substantial amount of money. If they go into bankruptcy, I think that is something that they don't need to pay, because actually since they were ready to authorize and not authorize, they never sent in a bankruptcy opinion letter. So, the bankruptcy opinion letter is meant to protect taxpayers, not really taxpayers, but I guess the USAC fund, USF fund, meant to protect in the event that somebody starts building out infrastructure, doesn't complete it or whatever, and then they default on that, or if they go into bankruptcy, then that money cannot go towards that. They have to have a letter of credit and then an opinion letter that says that money cannot go towards the bankruptcy proceedings. But I think they'd be okay, because they never did the opinion letter, because they never went through with it, as far as I know. They never sent in all that stuff. While the participation in this important program fit with our strategic vision in 2020, changing capital needs, a changing capital environment, definitely, and continued success in the urban multi-tenant market forced a decision to step back and focus our energies and capital on executing on our core business plan, he said. So yeah, they went public in, I meant to bring it up here. I'll bring it up here in a minute. They went public in March of 2020, and it was just not the best timing. They did okay, even though the market really started to trend down right at that point. I mean, literally, the day that they went public, I'm sure it's just a coincidence, but the day that they went public, the market started trending down, and they held their own for a little bit, but then the bottom dropped out, and their stock price has been dropping since. And I'll bring up a chart of that. I forgot to have it set here, but I can Google that real quick. And then, this also affected the capital markets. So it's really hard for anybody right now to get capital because of the way the market is. And not only that, but if you can get the capital, the price has gone up on that quite a bit, because the Fed is raising interest rates in order to try to suppress or get control over inflation, right? So here, when everybody was bidding for RDOF, prices were lower, so we didn't have the inflation that we have today. And it's been said that, some companies are saying that it's going to cost them twice as much, like to do their RDOF build, for various reasons. But inflation is a big part of that, plus the cost of capital. So the fact that if you have to get loans, it's going to cost a lot more. So these are part of the reasons that they had to give up on that plan. The FCC awarded Starry $268.9 million to cover 108,506 locations in 9 states. He said that by withdrawing, Starry freed up $17 million cash that had been restricted to cover its RDOF commitments. So these guys are going to be doing RDOF with a combination, I believe, of fixed wireless and fiber. So, but they had to cover, I mean, they were just not just going to be in urban markets. They're going to have to be laying a lot of fiber and not just doing, for example, fiber backhaul and then small cells and fixed wireless, 5G fixed wireless. I don't think they were going to be able to get away with that in a lot of the territories where they bid. So it's probably going to have to be a lot of fiber. The executive said he believes potential investors can see the value in Starry. The network is performing well and we're delivering on internet service at or above advertised speeds, he reported. He added that companies evaluating investment in Starry also understand that its cost and time to construct the network are competitive advantages. But again, that's specifically in kind of the markets that they're targeting, which would be these urban markets, again, apartment buildings or areas where you can do fixed wireless, and specifically millimeter wave if you can be offering gigabit. But they could look at, if they're not taking, let's say, for example, BEAD money, they could do fixed wireless using unlicensed CBRS spectrum in some areas and do some things like that, where they could provide fast service. It wouldn't be gigabit service, but they could provide fast service using mid-band spectrum. Mid-band spectrum like T-Mobile's and others doing, but they could do unlicensed CBRS spectrum, and that would be a way to keep costs down, and again, a competitive advantage over somebody that would be deploying fiber, let's say. Starry stock, which trades below $1 per share, doubled in price after the Q3 earnings call. Yeah, but they're still really well underwater here, and I was going to show this. So this was from their Q3 report. So you can see here the number of homes serviceable, almost 6 million here, but only 91,000 customer relationships, so about a 1.53% penetration rate. And customer relationship would be either an individual apartment where the whole apartment building is not, let's say, not being purchased at a bulk rate. So you've got individual subscribers that are signing up, or in some cases, apartment buildings will have a bulk rate with a provider, and they'll say they will purchase a certain number of apartment units that they're going to pay for, regardless of whether anybody takes it. And they've got some of those relationships as well. So you can see while they do have a large potential here as far as the number of homes passed, so to speak, or serviceable. Again, these tend to be apartment buildings. They don't have a huge they don't have a huge take rate on that. And again, a lot of the apartments are again, maybe federally assisted, so they do have plans for those. I mean, they do provide some discounts on that, and they provide the ACP benefit. So it does provide a way for people to be able to afford the internet, but not a lot of takers, relatively speaking. And I was going to look at their stock price. I can't type here on this little keyboard. Starry stock price, that'll get me there. So you can see here, let me see, so let's look at year to date. So right here is when they went public, and right about here is when the market started to tank. So they went public out of the gate, and they were experiencing some of that tanking. So they went public, looks like $9.21. Can I make that bigger? $9.21 kind of out of the gate, and they started losing. But then they started an uptick here looks like around April 21, started ticking up a little bit, and it got right to here, June 3rd, but then really the bottom dropped out. Started a free fall here. And let's see, date-wise, I'm a couple days down here. So really, a lot started happening in October. This was August, again, still trending down this whole time. So things are not looking good. So they're under $2 here, trending down even further. So right here is where things are getting serious. I'm sure they're seeing that the stock price is approaching $1. So they've probably had to figure out what they're going to do. So on October 12th, this is October 10th here, October 12th, and I'm sure word got out to, prior to that, but as far as the news reporting it, this is October 10th. You see they're $1.01 and 97 on October 11th. And then they reported around October 12th is when I saw the public reports that they were not going to be doing RDOF. So you see an uptick there. So this is, again, they saved some money by not doing that. And I think some people that were investing said, oh, that could help them out. But then they hit this. This is October 18th. And this is right about the point that they were announcing the layoffs. A lot of times layoffs, they'll announce layoffs and a company's stock will go up because people are like, oh, they need to do this. People know it's something they need to do. And it's like, okay, they're taking the steps they need to take. But the stock slid after that. I think this is the date I reported on the layoffs, and they were at 85 cents. So the last time I did something about Starry, they were 85 cents. And it just continued to go down. You can see here, let's look at just the last month. So again, you can see here, this is October 18th, and then they're sliding $1.32. Then here they're at 50 cents on October 24th. So that's 85 cents on the Friday. Then they dropped to 50 cents on the Monday, 42, 33. So they continued that fall down to a low here on November 1st of 18 cents. And November 1st is when they were having this call announcing that they were looking for a buyer to help them with, cash. So they recovered a little bit. So 18 cents recovered up to 28. And they've been hovering around that. They're at 29 today. No, that's November 7th. Yeah. What's today? Yeah, today's 7th. Sorry. November 7th, they've recovered to 29 cents. So, they are doing what they have to do, and they're certainly not sitting around waiting to do it. It seems like they're kind of looking at what's going on and then determining what they need to do to try to keep the stock up. And they're in penny stock range right now, which is not good. If you're under $1 on the exchange for a month or so, it starts to get where they look at maybe delisting you. So they're trying to do, I'm sure, what they can to get that stock price up, and I'm sure they'd love to have some kind of a buyer or merger come in to really boost the stock price to get them over $1, or to do some other, to be able to get cash in some other way to be able to start bringing the company back. So that's where they are. It's a tough market right now, and they're seeing the results of that. And you can see that stock price is taking a hit, and again, they're doing what they can. So again, we'll see. We'll kind of follow that and see what happens next. The next story may be that somebody looks at them as a good investment and decides to take them over, buy them in some way. I mean, a merger, with their stock down at 18 cents, I don't know if that would be a merger as much as somebody acquiring them at this point. So we'll see what happens. Thanks for joining me today for Broadband Deployment News. I'll be back tomorrow, I think, with a Tech Tuesday. I don't know what the topic is yet, but if I am back tomorrow with Tech Tuesday, it'll be at 3 o'clock live at that time, and then Broadband Deployment News the rest of the week. So thanks for joining me. If you're not subscribed, click the subscribe button, click the bell, and you'll be notified when I'm live. Take care. Bye-bye.